Well, we're learning more about the Nasdaq's difficulty with the avalanche of trades and cancellations before Facebook's IPO. One of the lingering questions among many, what role did high-frequency traders play in this mess? Eamon Javers been tackling the issue of man versus machine, and here's his take.
Hi, Brian. Well, I just wanted to give you a sense of just how fast all this happened on Friday morning. According to NASDAQ, it was 11:05 and 10 seconds where they attempted to complete the IPO cross process. That's what they call the process where they match up buying and selling interest in Facebook and then actually go ahead and print the first trades. What they needed there was a several millisecond period of time where nobody canceled their orders in order to make that final calculation and go ahead and print the first trade, and they just could not seem to find it, NASDAQ says. And once somebody canceled their orders in that tiny little slice of time, if a cancellation order came into place, the system would reset and start to calculate again. That is, we believe now, why we saw that delay on Friday morning as NASDAQ attempted to get that first trade out of the gate. Now, meanwhile, today I've been talking to HFT critics, high-frequency trading critics today, who say that all of the disruptions that we saw on Friday, Brian, created enormous arbitrage opportunities because some of the exchanges were slightly off each other, and high-frequency traders were able to profit from those minuscule mismatches all throughout the day on Friday, Brian. That's what the critics are saying, and they say this causes a lot of instability in the markets, and it causes the kind of problems we saw on Friday.
Absolutely. So I guess the question here is, Eamon, is it time to slow the machines down? I mean, obviously, it's been quite painful for some people. If you bought at the high on Friday, you've now lost over 20%. Well, joining us now to debate man versus machine is Andrew Stoltmann, a partner at Stoltmann Law Offices, and Jim Angel, professor of finance at Georgetown University. Andrew, why do you feel that the NASDAQ glitches have the fingerprints of HFT all over them?
Well, I think it's pretty clear. I mean, when you are talking about order cancellations in tens of millions of shares, literally milliseconds before the IPO is supposed to go public and people are allowed to put trades in, I think it's pretty clear that this is and has directly to do with high-frequency trading. And this is the sort of activity that high-frequency traders engage in, and it's really problematic. This isn't the first time it's happened.
Jim, do you feel that it's clear that it has the, the fingerprints of HFT all over it, or is it not as clear for you?
It's not as clear yet. I'm sure we will discover more in the near term, but I think we should not rush to judgment and say that anyone who uses a computer is bad.
Well, I think it's a little more than that. Nobody is saying just because you use a computer to enter trades, you're bad. But, if you look at the historical performance of what high-frequency traders do, they create disruption. They create mass volatility. Remember, it's only a little over 2 years ago that we had the massive, 10% drop in the market, about 1,000 points due to the flash crash. So what are we supposed to do? At some point, we have to say these high-frequency traders cause so many problems, we have to ban it or otherwise get rid of it.
Andrew, I'm going to let Jim jump in because Jim, I've read some of your stuff. I mean, your argument is, yeah, this is not great, but the regulators need to speed up rather than the markets having to slow down.
Right. And also, you need to distinguish between the good uses of fast computers and the bad uses. There are plenty of good uses for people who are doing legitimate things, like making markets, like making sure that the price of your ETF is properly linked with the cash market that makes up it. So there are a lot of good uses of fast computers. And if people are out there doing bad things like putting out such a high frequency of data that they're contaminating the market, we need to deal with market manipulation. Well, I certainly know that we shouldn't say that anybody who uses a fast computer or whoever cancels an order is bad.
Well, of course, the regulators are already looking into these glitches. And here's somebody else who believes that we should be asking the regulators what more they can do. Let's have a listen to Tom Joyce. He's the CEO of Knight Capital about this issue this morning on Squawk on the Street.
This had nothing to do with you against the machine. This was simply a technology problem. This was like your server going down, except on a massive scale. And instead of stepping back and rebooting, they kept plowing ahead.
So, Andrew, the question here is, I know that you're anti-HFT, but if it is not banned, how do we make it better?
Well, that's a problem. I don't know if you can make it better. I mean, I agree that there are some useful...
How do you define it?
Well, yeah, that's another issue. How do you define it? But the biggest problem is if you're talking about trading in microseconds, are there some benefits to it? Well, of course, but do the cost of the small investors and the retail investors outweigh that, the limited benefits? And I think it's clear when you have this sort of insane volatility, this sort of problems when it comes to an IPO like Facebook, you have to ban it completely.
But Jim, I want to take a different tack, right? A lot of people are saying that this is a bit of a victory for the NYC, that if Facebook had decided to IPO at the NYC, this wouldn't have happened. Essentially, there would be, for example, a central human being who could step in, do something about it, hold it, or just basically be there, whereas that was not the case at the NASDAQ. What do you think about that?
Well, if you just look at the trading of Facebook during the day, it looked pretty normal for an IPO regardless of where it was. If you looked at how LinkedIn traded, there it opened on the New York Stock Exchange. It was delayed quite a bit while they found the opening price. And after it opened, it was also a very wild ride. And so if you just look at it from the perspective of price discovery, the market did a pretty decent job of discovering a price. And we know that an IPO like this is going to be wild, and it worked.
You know, Jim, I argued that I thought it was a pretty successful IPO. I know people beg to differ, but my view is they priced it, it seems, reasonably fair, if not maybe a little too high. We didn't get the 50% spike, but we're not supposed to, right? They raised the allocation, and it seems like most of those shares were met. Maybe not all. Maybe they were a little too heavy on the share allocation side. Would you view Facebook, and I know this is probably a contrarian view, as a relatively successful IPO?
Well, Facebook is certainly a successful company. And certainly the underwriters placed billions of dollars worth of stock. So from that perspective, it worked. Yes, there were plenty of glitches on the opening. And however, the market discovered a price which was somewhere in the reasonable neighborhood of where it should be trading, given what the market thinks about the company.
Yeah. Okay, to both of you, thank you so much for joining us.
Thank you.